Yes, a couple of things I put in the chat here for everyone. Our email address, how to get a hold of us, our link to our challenge page, as well as to our YouTube channel of these recorded sessions. The first session was in detail, all of the guidelines and rules and regulations and that sort of information. That was a 25-minute session. It's got all the details for you. I don't have any assistance here today, so I have to multitasking, which is not good for anyone. Do people see the chat here that I've sent in? Does anyone? No. Okay. I put it in before. I will put it in again. Bear with me.
I'll make sure that you select everyone in the two section.
Yeah. There's our YouTube. That's our YouTube link, and this is our email and information link. So I'm going to start with just a few minutes of going through some of the overall summary of some of the details of the challenge. This will take 2 or 3 minutes, and then we will we'll continue with our Q&A session. Okay, there we go. So I'm going to just run through a few slides here very quickly, just to bring you familiarize you with some of the details. I would recommend everyone goes to our website, goes to the links in the chat there. Just about us, we have been running challenges for 5 years. We've received over 300 applications from 30 countries, and we have put out $6 million in catalytic funding to teams to do work within our challenges. We have funded over 30 pilots in our area, and our teams have gone on to raise over $38 million in private investment. That's important. The goal here is to try and help your companies grow by getting further investment as well as paying customers. We've also, our companies have also created and retained over 120 jobs and supported over 200 jobs created in the resilience sector. So we want to continue this. This is what we're looking for from the companies that we fund. We want you to grow and be successful around your solution. This year, we're looking at the Flood Insurance for the Future Challenge. And this is the first challenge we've had where we've had a concrete goal to reduce flood-related insurance premiums and payouts by 50%. What I raise this with you for all the companies thinking of entering. You will be asked in the application form to explain how your solution will get you to this goal. And if not to this goal, how close to the goal you believe you can get. So if you think you can only get 25 or 30%, then please explain that. That doesn't exclude you, but it helps us in our judging process. If you are a company that's just offering a part of a solution, we want you to explain to us what else you need, what other partnerships you need, what other capabilities you need in order to be successful to get this, and how you will measure that reduction. So this is all very quick. I can answer more of your questions offline afterwards. Please reach out, and we continue to post the answers to the FAQ page. What we're offering here is 300K up to 300K to individual companies, or if companies team together, we can offer up to 750K in grant and revenue-based loan funding. There are a number of other things in the bullets here that we offer to support the companies, as well as business accelerator help and office space and that sort of thing. So we offer support to the companies that we select to fund. Just some important dates here, and this first one, these dates may change, and this first one probably will change. I'll explain in a minute. November 30th right now is the application submission deadline. December 20th is when we will select finalists to come and provide us more detailed work plan, business plan information to the judges. We will then select teams out of that, select teams out of that to come and pitch to us. Those pitches will start on February 1st and run through the 11th. They'll be done on Zoom or if possible in person. At the end of February 2023, we will announce the winners and the funding amounts. And March 2023 will be keep getting the companies under contract. We have a deadline for the project completion of December 31, 2023. We are running this month is running a number of weekly info sessions, this being one of them. Next week, we'll be talking with Jeff Dunsavage of the Institute, the Insurance Institute, about using data to determine risk and the work that he's been doing and his organization's been doing in that area. The 17th, we will bring Charlie Sidoti from the InsurTech area to talk about his sector and what he's seeing and how he works with InsurTech companies. November 22nd, just before Thanksgiving, may be sparsely attended, but I'll be here and I'll be answering any questions you may have going forward. We wanted to bring in Scott Williamson, Reinsurance Association of America, to talk about NFIP, Risk Rating 2.0, as well as the Community Disaster Resilience Zones. This is a topic that's coming through the Congress right now. It's a topic of great interest, particularly to regions like ours that want to qualify for government funding at preferential match rates, as well as tax incentives and attracting private capital. The CDRZs, the CEDARs is one way to do it. And we have a suggested topic area in our guidelines. We were not able to get Scott in, he wasn't available this month. December the 1st is the first time that he can be with us to explain and answer questions. It's such an important topic that we've got him on December 1st, and we will be pushing the submission deadline out to December 7th for any in case there's any companies out there working in this field that want to develop a submission around it. We felt it was only fair to give them a few extra days to digest what Scott might say and any questions they might get answered. So we will we'll be extending from November 30th to December 7th on that basis. And we'll be making a formal announcement of that shortly. So today we've got some great experts. This is the time where you folks on the call with companies thinking about submitting, this is your time to ask questions. I would ask everyone to turn on the camera, since it's much more of an interactive environment if you do so. We've got three folks that I'll start off with a few questions and then we'll open the discussion up. We've got Hanni, who's a Senior VP of Strategic Partnerships with the Hamilton Group. We've got John McIntyre, the Managing Director of the AmFam, the American Family Insurance Institute, an investor. He's been an investor in a company that came through our challenge a few years ago, and I think he's got a very good background and can provide a lot of information about future investment possibilities. And we have Raghuveer Vinukollu, who's a Senior VP of Climate Resilience and Solutions with Munich Re. So I'm going to stop sharing here. Hang on a sec. I'm going to open up to start discussions with we'll start off with the reinsurers first, with Hanni and Raghuveer. And what I'd ask, first of all, we'll start with you, Hanni. I'd ask just take a couple of minutes just to introduce your company to the group here, and talk to us a little bit about, from an industry perspective, the challenges with taking risk around the current market dynamics and in the flood insurance business as you see it. So go ahead, Hanni, and we welcome your comments.
Certainly. Thank you, Paul. So Hamilton Insurance Group, circa 10 years old now, and we've been participating in property catastrophe reinsurance and specialty insurance on a worldwide basis. My particular specialism is in natural hazard catastrophe reinsurance and retrocessional reinsurance. I've been involved in managing risk and analytics functions for capital management for a long time now, and I also manage an underwriter portfolio of third-party capital risk that we write for on behalf of investors. So the interesting thing for the industry here is that flood has often been viewed as a diversifying peril, but I think we're all very conscious as well that it is highly correlated often to very capital-intensive events such as Hurricane Ian, Hurricane Harvey are excellent examples of how there can be a great deal of clash with the wind component of a natural hazard, and this puts a lot of pressure on balance sheets for insurers and reinsurers. The consequence of that is that it's often a peril that ends up getting a rather higher capital charge for it, because it can have this kind of very broad-based risk profile, and that means that the premiums that appear to be associated with it can be quite a lot larger. If we think about the challenge that the US has in particular in its marketplace, it's very much a function of take-up. So flood is not as widely purchased within the US market because it's separated as a standalone cover. Whereas if we consider much of Europe, if we consider Australia, Japan, a lot of the other large insurance markets, flood is generally a default included peril in all policies. And the principle of insurance is that you are spreading the risk over as wide a participation base as you possibly can. And we have a dynamic, particularly in the United States, where that is not realized. Consequence is that those that are exposed to flood pay a much higher price than if it were distributed more evenly across the entirety of the population. Ultimately, as a society, the United States pays for it largely through taxation, and then the redistribution through subsidized insurance via the NFIP and other such instruments. So ultimately, the challenge here, which I think is a fantastically ambitious but very sensible goal of 50% reduction in premiums with 50% reduction in payouts, that's, if you can reduce the payouts by 50%, you can reduce the premiums by 50%. You've got to be very conscious, though, that in an environment where the sea level is rising, and we have experienced a prolonged period now of above average losses, the frequency isn't materially high, but the losses are higher. People generally like to live on the beach and by pretty rivers and lakes, which means that they're more exposed to flood. But where you have this dynamic, and if you're able to realize a reduction in the loss cost, then the premium reduction will be down relative to where it's trending. And we've got to recognize that over the next 10 years, the cost of insuring against flood is only going to go up, and it's going to go up materially. So the goal here is not about whether you can reduce it by 50% on today's dollars, today's terms. It should be about, and it's much more achievable to say, can we reduce it in 10 years' time? Are we going to find that the actions we take today can limit the increase in premiums from being 100% to a factor of 50% on what they're going to be projected moving forward? And as a cautionary story, I would encourage people to look at where the Australian insurance market is, largely as a function of flood losses today, where we have properties where it's in some instances the premiums that are quoted are material, if not close to 100% of the insurable value, because almost entirely because of the flood cost associated with the risk in Australia at the moment. So that's where the US market could be heading, and ideas to stem that trend are powerful. I'll stop talking.
Okay, thank you, Hanni. Raghuveer, do you want to give the Munich Re aspect of insurance, and then we'll talk with John. By the way, if anyone has questions here, raise your hand electronically, and we'll jump to them. So go ahead, Raghuveer.
Yeah, thank you, Paul. You all can hear me okay?
Yeah.
Okay, excellent. So yeah, just a quick one-liner about Munich Re, one of the reinsurance companies in the world. So we deal globally. In terms of the peril of flood, I think Hanni touched on a really good points. Particularly, I like the point that look, flood is not covered as part of the main peril and the homeowners insurance, which kind of puts people surprised every time after an event you see an article in the newspaper, and there'll be at least a code saying I didn't know I didn't have flood insurance, or maybe I didn't know I was at risk. So that highlights a couple of things. One, the education is missing, right? That's the big part that's missing, is people don't know what their risk is. And the second part that I feel that is, I wouldn't say it's missing, but it's actually kind of creating misinformation, is the part that we have binary flood zones in this country. So, and now I'm not blaming anyone. The reason I say that is because flood zones were created back in the 1968 and after the law came in, and they used to be called the firms. And what is the firms? The flood insurance rate maps. What they were is they were created in terms of kind of managing the floodplain, giving people the choice because the risk was so high in these floodplains. So people were kind of given these zones and saying, if you have a mortgage, then there's a financial risk, so you will need insurance if you're in the special flood hazard areas. And there was a timeline of 35 to 50 years to kind of manage those floodplains while subsidizing the National Flood Insurance Program. Now, one thing happened, the other thing didn't. And the thing that happened was subsidization of the flood rates happened continuously, but not the floodplain management never happened, because you can't tell anyone to move away from where they live. That's not possible. But we can tell people how to rebuild. There is something called building codes. We know that works, but that didn't happen either. So having said that, what has happened in the recent times, I've seen and this was a question that we posed at a couple of workshops recently, is like, when did firm maps start becoming called flood maps? Why are we communicating flood risk based on a zone? As a hydrologist, I categorically deny that. That's absolutely unacceptable to communicate flood risk based on a zone. That's just not acceptable. So we need to change that. I think that's really critical towards changing anything. Now, coming to the insurance part, this is also something that Hanni mentioned, right? Insurance, what is it? It's a risk pool. Ultimately, if you have a pool of risks and we find out there is a risk is at a certain value, you get charged premium accordingly. Now, for people who say that the NFIP premiums have gone up, or the premiums or they are really high, well, they are not. Well, first of all, because there's only around 5 million homeowners in the entire US that have flood insurance. Now, by default, if they're having it, that's because they have a mortgage or they feel that they are at risk, right? These are the people. So it's by definition an anti-selected portfolio. It's a high-risk portfolio. So yeah, the premiums will look high. Well, let's just do some math, right? There's 126 million homes in the US, or at least around that ballpark. And if you think about just the homes from Texas to Maine, there's about 56 to 60 million homes. Do you think what could the premium be for something like flood risk if this NFIP program had to be solvent? I would say, and I'm just speaking, this is my my personal interpretation. I'm not saying this is something that Munich Re believes in, but look at the 56 million homes, the average premium could be less than $200 and we could still be having a solvent program, right? So flood insurance premiums do not have to be. And so bringing that concept into a community framework is important. Now, insurance by definition is a risk pool. That means there is an underlying risk and a standard deviation, right? Which could be saying that 1 year we could have a big loss, 1 year we could not have, we could see a smaller loss, or 1 year we don't have loss at all. But how do we manage the risk as climate risk increases? I mean, the underlying risk is increasing. So the one way to address that is through risk mitigation. Now, that should not come as a surprise to anyone. Insurance, no matter what you see, health insurance or auto insurance, every insurance has a good behavior component to it. It has a loss mitigation component to it. But when it comes to flood and some of these climate perils, that's going to be challenging for a homeowner to do something, because unless there is certain framework established at a state level through building codes or some kind of a community level mitigation that has happened. So that's why a community would be a fundamental idea behind these kind of flood insurance topics, because that is how we can address the reduction in risk, which will be absolutely important to reduce these premiums, right? Because again, this comes to the point about back to the fundamentals of insurance. Insurance was not created for all events. It was created for the unforeseen events. So let's talk about flood as one of those perils where the frequency events can be mitigated to as much as possible. And then insurance can address that financial resilience piece through insuring for these severity events. I'll stop there. I think there's a question.
Yeah, thank you, Raghuveer. Yeah, we have a question from Brandon. But first, I'd like to introduce John McIntyre, who is an investor, an experienced investor, particularly in the impact investment area. So, John, you want to introduce yourself and your organization?
Yes, thanks. Hi, everybody. Glad to be here today. Thanks, Paul, for inviting me, and I'm really interested in this program. I think it's fantastic. So very quickly, just to differentiate the AmFam Institute from American Family Insurance. American Family Insurance Group is a set of about 5 operating insurance companies based just here in the US. We're not international, US focused. A couple of the other brands or companies under the group would be the General, Main Street America, Homesite, Connect, are companies that we've acquired or merged with over the last 10 years. So in the last 10 years, AmFam Insurance has grown as a property and casualty direct insurer. We're probably, I think we're the number 8 insurer for P&C in the US. So that's our parent company and my limited partner. So back about 10 years ago, AmFam set up its first venture fund, which is AmFam Ventures. And I want to differentiate us from them. So AmFam Ventures is an insurtech venture group. They have multiple limited partners. AmFam is the first and biggest, but they have a number of insurance companies now that are limited partners with them, and they're doing direct investment in insurtech companies and related areas. So it's not strictly insurtech, but predominantly insurtech. And they're on their 3rd fund as a venture capital group and working on their 4th fund. So they're doing really well. So in 2018, there was a desire to address social impact, corporate responsibility, and kind of take it to the next level. And so I'll give you the long name one time, the American Family Insurance Institute for corporate and social impact was created. So we're a benefit corporation. So we're a standalone group. And we do programs, we do partnerships where we fund various things, and we have a venture capital fund. So that's my job. I run the venture capital fund. We've got a team of 7 people plus 2 half-time people, so 8 people. And I just gave you the website there so you can differentiate us from AmFam Ventures. So we're a double bottom line venture fund. We do direct investments in startups. The 2 bottom lines are financial, of course. We are for profit. We want to make money as a fund, and we want the startups we invest in to make money so that we're all sustainable and scalable. And so we have now $100 million under management. We've done 28 investments over the last 3 years. We're in 4 different social areas. So I won't go through those here today, but the one area that's relevant to this is what we call resilient communities. So it is climate tech, it is water management, it is disaster or catastrophe management where we make investments. And so, as Paul noted, we invested in a company a couple of years ago, went through the program, Storm Sensor, because we need data. We need to know what's going on in our storm systems and our sewer systems and so on. And we've made other investments in these areas. Another notable company in our portfolio is One Concern, which is doing digital twins. And working with the reinsurance industry, but also directly with corporations who are looking at their supply chains and all the liabilities they have and helping them create digital twins for that. So that just give you a feel for it. You go to our website, look at our portfolio, look at our investment thesis to get more information about that. But we are very anxious to find startups who solve this very problem. So unlike our InsurTech sister fund, who's looking at all kinds of different solutions for the insurance industry, our focus, our mission is to close equity gaps in America. We have lots of equity gaps in America. But as climate change is impacting us, we do know, and I'm sure you've all heard, that it is impacting communities, low to moderate income communities, much more harshly than those who are in more well-off communities, because they tend to live in areas of cities that are older infrastructure or in rural areas where they're more exposed to catastrophes. So that's the focus with our fund. So I just want to make that really clear with everybody. When we look at individual investments or we do our investment thesis, we very much want to expand the number of households or individuals or communities that can get access to products, insurance products, or other financial products for that matter, that can protect them. And because that's the promise of the industry, right? But as it's already been highlighted with flood and other areas insurance, as we have climate change, that is forcing costs to go up. It's been a dramatic year from a cost point of view. You hear a lot about the hurricanes and things going on the coast. We happen to be Midwest kind of heavy in our coverage. And so this has been a record year for damage due to wind and other types of events that do damage to property. So it's really, we're seeing that trend line up in the middle of the country as well as on the coast with wildfires and flooding. So we really want to tackle this problem of innovation. My comment about the industry, I don't come from the insurance industry. I've been in venture capital my whole career in technology. Is we need more innovation if we're actually going to accomplish this, because the insurance industry that I'm exposed to here in the U.S. Have existing business models that they're continuing to try to make better, but they're not really innovative, are they? They're responding to the increased cost of claims and inflation with increased premiums. So obviously it's all very obvious, but so we need different approaches, and that's why I look to all of you on this call and in this cohort to work on those. What we offer in return is funding. So as I said, we've got $100 million we're putting to work. We tend to write checks in the $1 to $2 million range, from seed funding through B round funding. And if you can help us solve this problem of, coming up with innovative solutions to reduce the costs so that more people can be insured and protected, we're anxious to write those checks. Happy to take any questions as we go ahead.
Thank you, John. So you guys have got a great panel of experts here. We're sort of running a little over time, but I want to keep this going for a few more minutes. I want to thank our guests for being here. Brandon, you've been patient with your electronic hand up. Do you want to go ahead and ask a question?
Thank you. And thanks for everyone for taking the time today. So I had a question. There's a lot of conversations around like homes. I was also curious about like, the communities that also have like small businesses or issues with transportation. Is that also a part of this challenge as well, or a factor? Or is it mostly just a focus on residential and the impacts in that space?
Largely residential is what we're focused on here. What did you have in mind? Did you have a particular application, any particular applications?
So yeah, we're my group and we've done quite a bit of work around the Great Lakes, and Detroit is one example that is at high risk of flooding.
Yeah.
And so there's also the impact not only on the residents, but like the access to like their own facilities and whether or not they can safely get there. So there's these kind of overlapping sort of, I guess, I don't know if there's like, other policies or things worth investigating from an insurance side of thing, or if that's appealing from an application perspective. So I was just kind of curious about that.
Yeah, I don't think I want to exclude anything, but certainly if there's an impact on the cost of insurance, that's certainly of our interest. Don't know if any of our guests, Raghuveer, Hanni, or John, have any thoughts on that, but it's certainly a big piece of living.
Yeah, just from our perspective, yes, absolutely not focusing just on homes. A small business is the driver of the economy in a lot of places, and we want to protect small businesses too. Again, who may not have the history or the economic wherewithal to buy traditional insurance. So, love to see solutions in that area.
Yeah, small business insurance is a huge part of the global insurance landscape. It's very important, and ultimately if people don't have jobs, they aren't living in a place anyhow, so it certainly should be considered a part of the broader landscape, I think.
Great.
Yeah,
Thank you.
with all those points. Yeah.
Any other questions from the attendees? You can follow up with me, send me questions for these folks. I'll pass them on and share the answers. We are a little bit over time here, but I appreciate everyone's
Carla put one in the chat, Paul.
Yeah. Okay.
Go ahead, Carla.
I just wanted to understand from the perspective of insurers, is nuisance flooding on your radar? And I think you're aware, ultimately with climate change, instead of, I guess, just the catastrophic high water levels, increasingly there's the low level nuisance flooding, like roughly we're talking maybe 3 to 10 centimeters of depth. And that's kind of a more pervasive, I guess, occurrence. And to the extent that it's detected, I know a lot of, I guess, academics and researchers are looking at it. And I think for estimates, it's increasingly shown to be maybe just as much or maybe even more than in terms of losses for individuals. But I don't know from an insurance perspective, how you think about that, or if you're, where you are on thinking about that.
So from a industry-wide perspective, nuisance flooding, where you're talking about low levels of flooding, are not something that should generally be picked up by insurance, right? It's not if you think about insurance, it's not there to Raghuveer's point, it's not there for the everyday thing. That is where we need mitigation solutions to eliminate the impact that can have on the quality of life of someone who's a resident in that area. That's a broader problem. That will often mean that what you really need is mangrove swamps, or you need to help restore dunes, or whatever it was that
Green infrastructure, yeah. That's what we work on.
that area did not have that nuisance flooding in the past. Ultimately, the insurance is there for the catastrophic outcome. So it'd be 2 feet plus of flooding really before you should be even thinking about making an insurance claim, right? Like the whole principle of insurance traditionally was to protect against try and make you whole following a truly terrible outcome, not the mundane and the everyday. If something's mundane and everyday, that's a different problem that shouldn't be solved by insurance. It's not risk transfer. It's
Yeah, I would have a different perspective. This isn't really about insurance from our point of view. It's about protecting communities and people, and nuisance flooding is just the beginning usually, right? So any kind of innovation that can help address mitigation or financial instruments or financial innovations, physical innovation, whatever it is, we would be interested in that, because we're taking that view of communities and social impact first, and insurance may not fit the traditional models. So that's fine. Let's look at new models that go outside of how we think of insurance today. That's how the Institute thinks about it.
So then for this particular challenge though, for how the goals are stated.
Yeah, well, maybe I'll leave it to Paul to answer that.
Okay, I just wanted
I mean, we are focused on, as I mentioned, on the premiums and payouts reduction. So if you can link it to that, if you can figure out a way to get some of the downward pressure on the insured, on the cost of insurance, and I think that then there's a connection there. We have run challenges in the past on mitigations and adaptations, and it's definitely of interest to our organization, but we're really focused on the insurance right now, insurance costs.
Maybe one other question then, just related to that, is what I think I took just a cursory look at the information that was out there, but what are the baselines that are being used for the discussion? So just around, reducing payouts, like if we are looking to make some estimates around that, what's the basis for the data that you have now, that you're using now for, I guess, the Hampton Roads region?
Well, a couple of things. One is we really the yardstick we have is NFIP, and NFIP. Not many people participate, as Raghuveer said, and even if you do, and you have a catastrophic event, it's not going to make you whole. I think the average NFIP payout in the past few years has been about $44,000, and that doesn't help anyone really. So it's really, as far as the benchmark goes, it could be the benchmark could be local, it could be based on it could be national. There really is no hard and fast number there, but what we're looking at is the general average costs for a community. And that can be calculated in a number of different ways. We can talk about that more in general offline, and we can put some information up on the FAQs. But there's a lot of information out there as far as community insurance rates goes, and that's a pretty good yardstick to use too.
Yeah, I'll just add 2 comments. Also just on the 2 questions. So in terms of totally agree with all what Hanni said, and the way I would think about this is also, again, what he said about the mitigation is required, right? So if you can inform if there is a way to address the risk assessment for the region and a proper modeling to understand that nuisance flooding, so that these communities can actually mitigate, that's already a good start, right? Because now you're helping in terms of reducing the payout, not just from an insurance payout standpoint, but also from a FEMA grants perspective. As Paul mentioned, the average payout from events may be around 40,000-50,000, But if you take some events like Harvey, it was 110,000 payout and it was 75,000 for Katrina. And so those are the numbers that you can actually look up in the NFIP website, and there's a lot of information there. But I also want to point out that the maximum grant, if they don't have insurance, the maximum grant that people get so far, at least in the last few years, last decades, has been around 30,000, which is nothing as compared to what these people have suffered. So insurance as a mechanism, it has to be there in terms of addressing that financial resilience of these communities. We can't rely on these grants and the billions of dollars of debt the NFIP program has to the Treasury, right? I mean, it's right now at 23 after waiving $26 billion of debt.
If I might make one additional point there. The way to reduce premiums is always to reduce losses. Insurance, for better or worse, is often priced on a backward-looking perspective. So if we roll ourselves forward 10 years, and mitigation efforts and building codes and whatever fabulous ideas that hopefully people are going to come up with reduce the amount of loss that hits insurance and reinsurance capital, you'll find that the price of the insurance on a forward-looking basis will come down. It's very, very simple. If someone can assume the risk and make a profit from it, then capital flows in. If no one can make a profit in it, capital flows out and the price goes up because it's a supply demand problem, in the same way as it is for lumber or for fuel, for oil. Like it's no different.
So I want to be respectful for people's time. We have run over. Really good discussion, really, really helpful. I know there's further questions out there. Please send them to me. I can distribute them, but I really appreciate everyone's time. Thank you to our guests, Hanni, Raghuveer, and John. I greatly appreciate your time and your expertise. And thank you for everyone else who's joining in. I hope it was helpful. And please stay in touch, and I'll try and answer your questions as I can. Thank you all very much.
Yeah, good luck with the challenge. Yeah.
Thank you.
Thank you, everyone.